Right. Well, the economy is once again in focus in the markets this morning. We had that soft retail sales data in the United States, maybe has people wondering about whether the recent conversation around interest rate cuts being pushed out is back on the table. Let's bring back Royce Mendes, who's Managing Director and Head of Macro Strategy at Desjardins. And before the break, we were talking about the state of Canada's economy and your belief that there's been enough real improvement on the inflation fight and enough evidence of a cooling economy that interest rate cuts are going to have to become a reality at some point soon. What is your expectation on what happens with rate policy in this country?
So we're looking for the Bank of Canada to begin lowering rates in June, 25 basis points, and then at each subsequent announcement, another 25 basis points. So they end the year having done 5 rate cuts. That seems like a lot, but actually, if you compare it to typical rate cutting cycles, it's actually quite gradual and gives the bank some optionality. If they need to take an announcement off, they can do so. Or if they need to cut by 50 basis points, they can do so. So I think it's kind of a balanced view of how rate cuts evolve. Typically, when you're getting rate cuts, they come down. You know, rates go up on an escalator and they come down on in an elevator. That's not what we're expecting this time. We're expecting them to go down sort of gradually, and there's more rate cuts into 2025, but again, gradually, and you end at about 2.5%. Typically, in a rate cutting cycle, in a recession, you would need about 400 to 500 basis points of interest rate cuts. We're only calling for about 250 basis points of rate cuts this time around. So that's because of the worries of inflation. Now, the reason you're getting the rate cuts is because of the weakness in the economy and what's going to happen to consumers in this country and businesses, but consumers in particular, as their loans and mortgages come up for renewal.
And I want to talk a little bit about the housing market in a second, but we haven't really talked about the jobs picture. And even this morning, we were highlighting Canadian Tire had quarterly results, and they are addressing softer consumer demand. But it was late last year, they were announcing some layoffs. The overall jobs numbers in this country, and you talked about the immigration strategy, which has actually been additive to the employment picture, but sometimes masks the overall health of the economy. What do you think the jobs picture is going to look like as we go through this year that might ultimately lead to the Bank of Canada having to think more and more about possibly cutting rates?
So I'll paint a picture of the current environment in the labor market, which is probably less optimistic than some might believe. You know, we've been creating jobs for months now, and it continued into this year, but it has not kept up, not anywhere close to have kept up with population growth. And so the labor market is actually weakening as we move forward in time. The fact that 50% of the jobs over the past year have been in the public sector is not a good sign of private sector hiring. You know, we talk about news headlines all the time about job cuts in various industries from various businesses in Canada. It's becoming a cumulative process of all the time we're adding these up, and they are pretty significant. So I think that the only thing that has kept us afloat has been these public sector job additions. And if we assume that that's going to slow down at some point, or should slow down at some point, we start to expect that we're going to get some negative job prints in the near future. And that will actually push the unemployment rate out. The concern there is that, for now, consumer insolvencies have remained quite low. But consumer insolvencies are heavily correlated to unemployment. When the unemployment rate starts to go up, that's when we worry about households going bankrupt.
Well, we'll watch closely. I think a lot of people are watching, for example, 6%, call it, on the unemployment rate level. Getting back to housing, Bill, it is interesting in a country where there is a great need. Obviously, every country has a need for housing, but especially with a growing population. We even saw it in the most recent real estate sales numbers for the country. Prices are still soft, but the activity is picking up, almost as if people are waiting to see more signs of rate cuts so they can get back into the housing market. And I wonder what you make of that when I would imagine for central bankers like Tiff Macklem, they don't necessarily feel good about the idea of everybody racing back into the housing market after they cut rates a couple of times.
I'm skeptical that this is a real resurgence in the housing market. I mean, when you see housing sales pick up and prices drop, that's not really a sign that their buyers were rushing in again to pick up housing. It could be just a sign that sellers were finally capitulating and saying, okay, our houses aren't as valuable as they were a year ago. The market is here. I'm willing to sell here. Because what you had seen, particularly in the Toronto area, is houses, single-family detached houses, just sitting on the market for months and months and months. And maybe they moved in January because the sellers finally capitulated, is the way I would sort of view it at this point. I don't think there's enough evidence, anywhere close to enough evidence, to suggest that the housing market is rebounding. And the housing starts data that just came out earlier this morning showed that housing starts actually slowed. So we're building fewer homes than we're already building fewer homes than we need to for population growth, and the pace is actually slowing, not increasing. I would argue that the problems with housing supply and shelter inflation can actually be brought back to the Bank of Canada's policy. High interest rates are making builders less interested in adding more supply to the market. If you think about, all the community of builders in this country, you've heard about projects being paused or canceled. In terms of other parts of housing inflation, you're seeing, obviously, the mortgage interest cost is being pushed up by interest rates, but also rent prices are up because landlords are passing along higher interest rates. So the Bank of Canada's policy of saying, we can't do anything about shelter inflation, it's fair, but that's at best. At worst, they're actually making the situation more difficult for Canadians by keeping interest rates high for too long.